Confidence in the confidence and housing, I should say, are two things the Federal Reserve watches very closely. And today, the central bank policymakers began one of their periodic two-day meetings. While a rate increase is highly unlikely when we get the results of that meeting tomorrow, many of the nation's top money managers and investment strategists do expect big changes down the road. Steve Liesman explains.
As the Fed begins its two-day meeting, the market is looking for a Federal Reserve that is easier than previously expected and starts later. And the reason? A stronger dollar and lower oil prices, a low outlook for inflation, and weaker economic growth. Here's the timeline from the CNBC Fed survey. 38 market participants polled. The first rate hike had been seen in August 2015. Now it's seen in October, 2 months later for the start of rate hikes. When will the Fed let that $4 trillion balance sheet decline? Had been April 2016, and now it's May 2016. How about when it will finally finish hiking rates? Had been the fourth quarter of 2017 at 3%. Now it's a quarter later at a lower rate, 2.85%. And the outlook for rates this year and next is also lower. If you look here, they lowered it by about 40 basis points for 2016 and by about 20 for 2015. So really just looking for two hikes here, 2 quarter-point hikes this year in 2015. Looking at growth, it's remained pretty steady despite all the headwinds that are out there. Still looking for 2.7% growth this year, fourth quarter over fourth quarter, and 2.8% next year. Still not reaching that 3% growth we've been looking for here. The probability of recession, however, remains pretty low for this series of the survey. Just a 15% chance or so that we'll have a recession in the next 12 months. What are the things that can go wrong? We asked about the possible risks to the U.S. economy. 28% say it's not here, it's overseas. Global economic weakness. 11% say it's here in the United States. Tax and regulatory policies, followed by geopolitical risks. Finally, a slow job growth. And then this last bit right over here, slow wage growth. Finally, we asked participants to grade the current chair of the Federal Reserve, Janet Yellen, versus the previous chair, Ben Bernanke. Overall, she does pretty much the same here on leadership. Transparency a little bit better, communication a little bit better along the way here. This is a combination of people giving Yellen an A versus those who give her a C because they think policy is not right. She beats Ben Bernanke by a little bit in the overall grade. For Nightly Business Report, I'm Steve Liesman.